You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Bork. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon, welcome back. Today is Tuesday, 30th day of April, 2019, last day of the month, last trading day of the month, and I think those days are supposed to be bullish. We had a hearty sell-off this morning, but the market is attempting to recover lost ground. But hey, so glad you're here. Thanks for joining us. If you're returning, welcome back. If you're here for the first time, a very special welcome to you. We are certainly glad to have you with us. Thanks for joining. If you can't see the chart I have up, S&P 500 Emini Futures, go to our homepage at CFRN.net. On the right-hand side, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and it'll give you one-click access to the show each and every day. The chat box, the charts, discussion, everything. Now, if you do find yourself away from the office, unable to access the desktop, just use your cell phone or tablet and go to youtube.com/CFRN/live, and there you'll find us live in real time, a simulcast of the daily show during the show, thanks to the good folks at YouTube. Thanks, YouTube. Okay, we're going to move quickly here. Michael has an appointment. We're going to bounce right over to him. I'm going to give you the numbers from around the world, cash markets. And then we're going to jump right over to Michael and get a recap of everything that happened in the live training room today. Currently, the Dow down 15 points. NASDAQ down 64. That's almost 1%. S&P 500 down 5. And the Russell 2000 down 8.5. In the commodity basket, crude oil up 46 cents, trading 63.96 last. Gold up $4, make that $3.60, trading 12.8510 last. In the Asian markets, at the close, the Nikkei was down 48 points. Shanghai was up 15, and the Hang Seng was down 193. In the European markets at the close, FTSE down 22, DAX up 16, CAC up 5. That gives us a mixed day in Asia, a mixed day in the UK, and here at home, it's still a big red Radio Tuesday. The markets are trying desperately to recover the lost ground. When I come back, I'll show you the S&P 500 index cash chart, and we'll see just how important this area that we hit really is. With that, let's go to Michael, get a recap of what happened in the live training room.
Okay. Excellent. Let's do that. Oh, wait, I gotta change my name. Hang on. Okay. Now, I can do change presenter to me.
That's you.
All right, here we go. So you should be looking at my screens right now.
Got them.
Okay.
It's all yours.
All right, great. And something else just came up too, so I got a whole bunch going on right now. Let's start out with this, okay? If you have not taken a free trial with us, all you need to do is go to the homepage at CFRN.net. I usually start out with the date. Good afternoon, everybody. Today is Tuesday, the 30th day of April, 2019. It's the last day of the month, January, February, March. It's the last day of the month, and it's actually our best day of the month. Dwayne had said that the ES was taking a beating a little bit, and that's okay. We make money if it's going up or if it's going down. All right, we don't care which way it's going, as long as it's going one way or the other. All right, so if you have not taken a free trial with us, go to the homepage at CFRN.net, and in the right-hand column it says 5-day free trial apply.cfrn.net. If you click on that, you will be brought, well, we'll show you to this page, where all we ask for is your email, your first name, and how you found us. Hit the submit button. Once you hit that submit button, you'll be sent a confirmation link. You must click on the confirmation link. Okay, if you don't click the confirmation link, we don't know that you took the trial. So you got to click on that link. Okay? Okay. All right, here we go again. This is a spreadsheet. This spreadsheet goes back over 6 years to January 2nd of 2013. And it's our daily results. And this, today, because there was good volatility today, was our best day of the month. I think all these slow days leading into today, we're probably, just waiting for the earnings to come out. Hopefully, it's going to open up next month. If you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Today is the 30th day of April 2019. We made 14 ticks in crude, 10 ticks in gold, and 10 ticks on the ES to put us at $365 on the morning. Now that's one contract, 2 hours. And I did miss some trades. So there could have been much more than that, probably double that. Today it took 15 minutes and one trade to get to the goal for the day. At that point, we're up $100 a contract, and we took a total of 7 trades. On the month now, we're at 2,087. That's over 20 days, averaging 104 per day. On the year, we're at 8,540. That's over 74 days, averaging $115 per day. Okay. Okay, let's go take a look at what we did or didn't do. Gold. Let's back it out a little bit. See, I told you we missed a couple of trades. There was one right here I didn't get filled on. There was one right here that we did get filled on, that I picked up 7 ticks on. One right here I didn't get filled. And then the market changed directions. Now over here, you see the cycle change color down here at the bottom? So we couldn't take the bounce off the BBC. It's too bad because it was a nice bounce and I was expecting a good move. But it's rules-based trading, so we couldn't do it. Okay? We could not do that. Then it got kind of flat for a while. And the next opportunity was right over here. And okay, well, anyway. we got 2 ticks on this, and somewhere else there was a trade in here that we got 1 tick. I don't know where it was. But there was a trade in here that we got 1 tick. But we got 2 ticks here. And that was it. And as usual, after 11:30, gold just flattened out. Gold just flattened out. Okay. The euro. Well, the euro had a little bit of opportunity today. But there was a bounce here that we didn't get filled on. And a short over here that we didn't get filled on. And that was pretty much it for the euro today. Okay, it was a lot of stuff going on. And anyway. Okay, over here was a shorting opportunity. This is crude oil now. In crude, we picked up our goal for the day right here, I think. We got 10 ticks right there. Yeah, that's 15 minutes. So we got 10 ticks right there. Then it got really choppy for a long time. It got really choppy. And it started to trend again. We had lower highs and lower lows. It's even lower than there. But we ended up with a break even there. And then it dropped, but the cycle was not giving us an opportunity to go. Okay? It changed directions, and over here, we couldn't do a momentum long trade going into unbroken dynamic resistance right here. We had to wait until we broke it, and then we could do it right here. And we did, and we picked up 4 ticks. Okay, we missed this opportunity right here, which only gave about 4 ticks. Well, if you stuck with it, it gave more. But then things got sideways. All right. There was nothing during the break on crude. On the ES, it was just horrible. Horrible trading. Well, I mean, there was no trading. Horrible markets during the first couple hours. And then, right over here, we had an opportunity to short, and we did, and we picked up 10 ticks in that one trade on the ES. There was another follow-up right here that I missed because I was filling out my log. And then it changed directions, got back up above the BBC, and no, there was not a trade setup in there. It was not tradable. Okay, so let's go back here to the spreadsheet. If you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. We made 14 ticks on crude, 10 ticks on gold, and 10 ticks on the ES to put us at plus $365 this morning. That was our best day of the month. It was. And I said yesterday, I was hoping we were going to have a good day today because I wanted the average to be over $100 a contract. So our gross profit, 2,087. That's over 20 days, averaging $104 per day. And on the month, on the year now, we're at 8,540. That's over 74 days, averaging $115 per day. Now, our deal is that you don't need to trade to get, $800 per contract per day. You need to be able to make $100 per contract per day consistently. And then you can just add more contracts. All right. So if you go to the homepage at CFRN.net and you click in the right-hand column where it says free 5-day trial, it's going to bring you right here where it says apply.cfrn.net. And there, all we need is your email, your first name, and how you found us. You hit that submit button, and you'll be sent a confirmation link. You must click on the confirmation link. Okay? If you don't click the confirmation link, we don't know that you took the free trial. Okay? Okay. That's it. With that, we can pass it back out to Studio A, overlooking South Mountain, America's largest city park, in fabulous Phoenix, Arizona. Dwayne, if you are ready.
I am.
Excellent. Okay. And let me scroll up here. John's not there yet.
Yeah, I just spoke to him. He's on his way.
Okay.
I know you got things to do, so if you got a dash, not a problem. I'll open up the deal so I can see him when he pops in. And I can open up his mic, okay?
Okay, great. Thanks. All right.
All right, folks, we're looking at a chart of the S&P 500 Emini Futures. Got something I might want to show you, but you got to look at it first. Hang on. Over time, you learn with live radio that maybe a better check first. Just stand by. Let me look. Still looking. Hey, better look some else. Still checking. Got a little bit of news, but it's not the normal little bit of news. It's a different little bit of news. Try it again. I found what I'm looking for. Okay. I know that many of you have an eye on gold, and beyond that, some of you have an eye on mining companies, bring gold up out of the belly of the earth, and some of you even look at junior mining companies, and some of you participate in this thing called Santa Fe Gold. Well, we have news dated yesterday. Santa Fe Gold Corp, a U.S.-based mining company and owner of 148 mining claims covering 42 mine sites and potential mines, is pleased to announce the commencement of ore production. That's with a capital P, production, from its Jim Crow mine located in the historic Steeple Rock mining district of southwest New Mexico. Now, the Jim Crow mine consists of a 300-foot deep, steeply inclined shaft with lateral workings along the vein on the 200-foot and 300-foot levels. I'm reading from the press release. We believe limited historic production has been from a zone extending from the 300-foot level vertically up through the 200-foot level and for an unknown distance above. Initial ore development is planned to be above 200 feet, with the produced vein material collected on the 300-foot level and transported to the shaft for hoisting, A lot of technical terms there. The ore development underway should define the extent and quality of this mineralized zone. Initial production is planned to be stockpiled on the surface in preparation for shipment to Arizona smelters. The potential for developing additional mineralized resources within the Jim Crow mine and in the adjacent Imperial mine exists in multiple directions. In addition to the Jim Crow vein itself, which is undeveloped both laterally and at depth, we believe there are two parallel veins showing potential economic grades and widths on the surface, 170 feet and 320 feet to the northeast, respectively. We believe all three of these veins converge and project to intersect approximately 1,500 feet to the northwest. A similar mine, the Balali, is located approximately 4 miles to the north of the Jim Crow. The Balali mine is accessed by a decline, and it is believed that this mine contains several parallel veins. The chairman of Santa Fe, Brian Adair, said, "We are very pleased with our overall achievements to date to be able to announce commencement of production of ore on schedule, having made what we believe to be considerable progress at this point." So there you go. I mean, there's more. If you Google up Yahoo Finance, I'll read the end paragraph here. Santa Fe Gold is increasingly well positioned to become an operating mining company. Although the Jim Crow, Imperial, and Balali mines were initially highlighted for their near-term production potential, the additional 8 mines within the district may be developable and available for later production. Read it yourself. You can go most anywhere, just Google SFEG news, and it'll pop up. So, is this a beginning? Is it a start? We'll see. We will see. And by the way, that is not a recommendation to buy or sell any security. I'm just telling you what I own. The disclaimers on the website. What I own, what I bought, all that. It's all there. Okay? So just take a look at it. Now, this is a penny stock. I probably don't need to tell you, but I will. Be very careful. If you own 10 penny stocks and one of them brings home the bacon, you probably end up doing quite well. But you have to understand that if you own 10, none of them may bring home the bacon. Follow me? Good. That's my story. Let's dig into it. Beautiful thing about the truth, right? Okay. Let's take a look at this chart. It is the S&P 500 Emini Futures. And I put this in the Telegram channel yesterday. We had an alert to be long 29.44 up to 48. We did it once, got back below the trigger, did it twice, got back to the trigger, did it thrice, and then as it came back, I must have spooked it, I guess, because as you can see, there's a 4 with a question mark, as if, are we going to get a 4th run? We didn't. And what this chart says to me, you see where number 4 might have come into play? Right here. Remember, this is an important price and an important area. You see what happened? You see that doji? These are 30-minute candles. Yep. That sparked the sell-off. But we were caught by last week's weekly trading zone at 29.29/30. The market did find good support there, and we've staged a rally so far about 10 points back up to 29.40. Now, yesterday we ran out of time. I was going to put this week's weekly trading zones on the chart for you. I don't normally do that on the radio show here or for the community at large until Thursday. Of course, weekly trading zones go to the partners and passport holders every Monday morning at 6:15 a.m. Eastern. And then I disperse them to the general community on Thursday. So, overhead, we have 29. We're gonna go way up here. Highest weekly trading zone for this week, 29.96. Don't worry about the yellow. I was just using the yellow color last week. If you were here, you'll remember why. By the way, if you have any questions, put them in the chat box. We'll get to them. Open up the chat box so I can keep an eye out for John. I know he's on his way. Right. 95.96, highest weekly trading zone. That is only Tuesday. We have 3 more full trading days. And tomorrow we get a Fed announcement, an interest rate decision, and a press conference. So anything can happen. All right. Next is 29. I want to make sure you got to see this and this, okay? So now we'll move them. 29.59/60. There we go. Below that we have 46.47. Below that we have 33.34. So I'm just grabbing last week's zones and just pulling them into position. I know that many of you use the app that Michael created. For me, because of what I do, it's just, for me it's simpler to each week just drag them into the new position. $33.34. So we can see here, price has basically gone from zone up to the zone where it consolidated and spiked just a wee bit. Back down to the zone. Zones are an area. So while we often turn at the zone to the tick, like you see there, that little doji I spoke of earlier, sometimes we'll spike it. We'll spike above it, we'll spike below it. As you can see, we went from here, zone, to zone, and now the market is doing its very best to get back up to the zone. Okay? So from here, price is trading 29.3975. What is the high probability thing? Well, the market is showing you that. It's trying to get back to the zone. Price is always trying to get to a zone. Either the zone below or the zone above. Does it ever come short, fall short? Yeah, it does, right? Got to go back, get some energy, make another run at it. Okay? All right, so that's 33.34. Let's look at the next one. Which is 29.20/21. And sometimes it can be difficult. So you double click it. And suddenly, all is right with the world. Yeah? Okay. Now, below that, I'm not going to put it on the chart right now because it's not important, but just so you know, the next zone below is 2900/2901. That's a big number, okay? It's a round number, but it's a big number for a number of reasons. And if price can get below 2900, hold on a pullback, then we're going to see the retracement, the big picture retracement that we've been anticipating and awaiting for some time now. So you might want to mark that in your day planner, 2900/2901. If you get below that, hold it on a pullback, look out below, and then the lowest weekly trading zone for the week, 2870/71. Okay? So we'll bring this back into view. Now, remember this we talked about yesterday? This started back on the 12th. We had a swing high, we had a swing low, which led to this swing high and this swing low. We tiptoed outside and then popped right back in, rallied up, walked that trend line, that brings us to where we are right here, right now. Okay? Now this pattern, we're not pattern recognition people, but it's called by some a megaphone, by some a bugle. You may have a different name for it, but you understand it represents a market that is putting in, you see, a trending market will give you higher highs and higher lows, or lower highs and lower lows, right? Higher highs, higher lows, lower highs, lower lows. That's a trend up, trend down. When the market does what this market has done, it gives you a higher high, followed up by a lower low, that is definitely not a trending market. And it's an area that causes confusion for a lot of traders because they just aren't aware of the bigger picture dynamic at work. Now, we ourselves preach on a regular basis, trade what's in front of you, not what you think should be in front of you, but what is. And sometimes, because our minds get so filled with noise, we can't actually see what's right in front of us. Have you ever looked for something? Your car keys, perhaps? Maybe 10 minutes? Maybe an hour? Maybe you called the neighbor over to help you look? And then, all of a sudden, as if by magic, they appear on your bedside table or the kitchen counter, wherever you left them, right? How is it you couldn't see them? You must have looked at that counter or that bedside table 20 times. You might have even moved stuff around. But there was something coloring your perception that did not allow you to see what was right in front of you. That's kind of a big deal, okay? So we have to be very careful with the market, that we learn how to turn off the filters, turn off the noise, or at least turn it down, so that we can begin to see what it is right in front of us. Now, two people can look at one chart and see decidedly different things. Is that because they're confused by the noise? Perhaps. Could it be that the chart is showing different things to different people because of their understanding of the market? I think that's the better answer. Okay? So, we've now positioned the zones here on the S&P 500. So you know what the next high probability thing is. Now, just because it's the highest probability that price will attempt to go back to the zone doesn't mean it'll make it to the zone. This little doji fell, what, 2 ticks shy. That happens, right? Suffice it to say that even though that was a powerful move down today, we quickly recovered, and we've been inside of these 2 zones since the Globex open Sunday night. Where's Globex? Right there. At 28, 6 p.m. Eastern, Globex open. We strayed out of the zone a little bit there and a little bit here. Where are we right now? Back in the middle with you. Here we are. Time to hold up. All right, getting a red candle. All right, does that mean? Oh, so now we're going back to the zone below. I wish it were so simple. No, the market channels back and forth all day long. We know that. We accept that. Unfortunately, when we actually put a position on, because our indicators or methodology or whatever it is that we use tells us to enter a position. See, if you had gotten long right here, when you heard me say that the high probability thing is for the market to go to the zone overhead, right? Now suddenly, there's red. Because it's a conspiracy, right? The fat cats on Wall Street saw that one contract out there to go long, and I guess the way the lingo goes, the urban legend, they're going to run your stuff. Don't fall into that, okay? It's called stinking thinking. It's not true, it's not reality. But see, when we enter a position long or short, something in our brain clicks and tells us that that's the beginning of the next trend. Now, make no mistake, there's no trend here. We were up, we were down, we were up more, and then we were down more, and now where are we? Stuck in the middle with you. Right here. There's a great lesson here. There's a time, unto all things there is a season, right? Time to be long, a time to be short, and a time to do nothing. And that's what this is. Okay, could we pick something out here? I mean, if we think it's going to go zone to zone, could we do that? Yeah, we can. But any other grandiose plans above and beyond that can't happen until we get above this guy and below this guy. Now, the megaphone pattern, as it's called, or the bugle, whatever you call it, it just keeps getting wider. Could we stay inside of this thing for another week? Yeah. Could we stay inside for another month? Did he say month? I did. We could stay inside of this thing for a year. Because you see, with each passing day, it becomes more difficult to get out of it. Why? Because it's ever expanding. That's what makes it a kind of a dangerous pattern to, it's good to be able to recognize it, because you know to exercise caution here. Okay? Now, what happened when we got to the bottom? Hang on. Now, we couldn't even draw these trend lines and extend them into the future until first this happened, and then we were able to lay this on top, and by golly, price ran right to it. If you don't draw trend lines, see Bert, talk to Bert, let Bert help you. He and I did a video years ago. It's called Drawing Trend Lines with Bert, and that video has stood the test of time. Don't worry about getting trend lines perfect. Your trading platform comes with an unlimited supply. Just start drawing them. You're not going to get it perfect. You don't need to get it perfect. It's a visual aid. Okay? It's not a trick. It's not a gimmick. It helps you find the keys. You see what I did? I tied that back. Yeah, okay. Happy Tuesday. Tuesday, the optimistic day. So we hit the top. We walked it. And here we are. And here we are. From here, smack dab in the middle of the zones, the red 30-minute candle printing, this candle and this candle, the high probability next thing to happen was in fact a zone overhead. Now, if this red candle can take us below the low of the previous candle, I think you know what the high probability thing is there. That'd be a move from 36 to 34. It's 2 points. It's gold for the day. But what are the risks? When this green candle was printing, nobody expected this candle, did they? But here it is. See, that's what's in front of you. Not what you think, not what you want, not what you hope. Now, it's important to keep in mind that the market's channeled back and forth, back and forth, back and forth, day after day after day after day. It's just how the market works. So the next time you get into a position, long or short, doesn't matter the market, the second you get in, it starts to backpedal in the other direction. Don't freak out. It really isn't a conspiracy. They actually aren't out to get you. It's just that because you put money on the line, you enter a trade, now not only is your money at stake, but your reputation. And when I say reputation, I don't mean what other people think of you, I mean what you think of yourself. Because if this trade goes to the stop loss before it goes to the target, man, you're going to hammer yourself, right? And beat yourself up. Why? You identified the trade, you identified the potential target, you identified the acceptable risk, and you did what traders do, you put the trade on, right? This is a business based on probabilities. If you think you can ever be strong enough, lean enough, mean enough, tough enough to just rule the market, well, rethink that, all right? Just step back and say, okay, I've been trying, I have 10,000 hours of screen time. But you're still struggling with consistency. One of the reasons that people struggle with consistency in the market, now everybody wants a consistent return from the market. But you have to ask yourself, are you giving the market your consistent effort? Because in a business based on probabilities, you have to be the part of the equation that never changes. Now think about that. What you do, how you do it. See, once you identify whatever it is that gives you a definable edge in the market, and that's really all you need is a definable edge. And once you have a definable edge, the probabilities will take care of everything else. Just make sure what you have truly is a definable edge. Okay? All right. I think John got lost along the way. Let me see if I can roust him. All right, let's have a look at the Dow. These are last week's zones. I'll get these changed out for you by tomorrow's broadcast. Just want to give you an idea of what it looks like. Here's the Russell. Last week's zones. Still doing the job. NQ. Bearish cross, price pulls away, price pulls back. Down we go. This was just a little head fake. Leg, a retracement. You see this leg here, we just had 100% retracement. From here to here, back to here. This was a bullish cross. It was a continuation of this because that right there was a little head fake. So really there's the whole leg, but we're talking about just the last leg. Just the last leg up, 100% retracement. The fact that this couldn't move higher to challenge this high is telling to a degree, but there's really nothing that we can do here on the short side. Now, let me just clarify that. Could you be short back down into this area? You could. Okay. Is there room to run? There is. Could that give you your goal for the day? It could. Here's John. Hey, John, welcome to the show. How are you, John?
Oh, fine, thanks. Sorry, you know what? Your reminder thing is hasn't come up in the last couple of days. That's why
Really?
I was a bit late.
Okay, yeah, no problem. Let me check into that and see what's going on. But thanks for letting me know.
Listen, it's a pretty big, interesting day today. Yesterday, I was a little bit slow off the mark. You know, I just saw the downturn coming right ahead of, you know, in the last half hour or so. And I kind of instinctively knew I should have just jumped on it and gone short right away and sold everything, which would basically been long right up until yesterday. And but we got it just, you know, as soon as the Google news came out, which was down, it was only down about 50, I think, when we sold it and shorted it, and it finished up down 95, and I think it's down further this morning, or it was earlier on. Anyway, I basically told people to go short overnight, and I said to be ready to cover because of the Fed. You know, the Fed, this is sort of like a pre-Fed sell-off. But if we don't rally anymore right now, we had a kind of a rebound. The reason why we got the rebound is because the you know, for the first time in a while, they had a very productive meeting at the White House regarding the infrastructure bill. And it looks like there's a meeting of the minds about $2 trillion, which is awesome. I mean, it's just way better than expected. You know, I mean, it was originally $1 trillion, and if they're committed to doing $2 trillion right now, what's not to like about that? I mean, that's probably going to help Trump enormously in terms of 2020, and it's probably going to help a few Democrats get reelected as well. But it's nice to see the Democrats actually being rather kind of more cooperative this morning and not critical. It was kind of meeting we would like to see all the time instead of the vitriol that's been going on. And I'm all for that. Bring it on. But certainly bring on this $2 trillion infrastructure bill, which is going to focus on transportation and water issues, power issues. They're talking about better power distribution and better, clean energy, I guess, and just as well, incorporating some clean energy. And, there's a lot of improvements that can be made with the grid, making it safer, against the possible, what do you call those, the things that knock the grid out? Forget now. But, the impulse, sort of a,
now it escapes me.
Yeah, but anyway, everybody knows what we're talking about, which is like a impulse, some sort of an impulse weapon. Anyhow, and most importantly is the high speed access, the broadband improvements. So it's really obviously that's going to be incredibly good for the tech stocks. Probably going to be very good for Cisco, which is already one of the better performing stocks this year. Now the 5G is getting more mainstream. So this is really a big deal. And now there's been a big spike down this morning, as we can see, and a fairly decent comeback. So given the Fed's coming, there's a possibility the Fed might lower rates tomorrow. There's been a bit of chatter about it. That would be outstanding if they did. I think it would be a very smart move. Probably would push the markets back up towards the highs again. And we actually closed an all-time high yesterday before this pullback. Not on the Dow, but on the other stuff. And that was quite something. But we're getting so close to 3,000 and coming back down like to the if you add a zero on the end of that, it would be like coming back 1,000 points, sort of down towards the 29,000 to get up to 30,000. So it kind of makes sense that there's some testing of the low end to give the propulsion to go through the high end. And that may be coming in the next few days, because Powell has kind of definitely won a lot of points back for this rebound in the market. And if he says a lot of favorable things, which is almost for sure what he's going to say tomorrow, in support of one of the strongest economies of all time, without the drawbacks, at least for now, i.e. inflation and stuff, it could be very very positive for the markets for the rest of, remember it's the 1st of May. We're closing, we're having one of the, we're going to up 4 months in a row. That's a very, very rare phenomenon to be going up 4 months in a row. It's really quite remarkable, especially, and it's the biggest 4-month gain of probably of all time. So, it's really kind of overwhelmingly good all around at the moment, but it mightn't hurt to lower rates a bit, maybe for a couple of for now, and maybe one more. I don't think they're going to lower it really, but you never know. If they did lower rates, this would just set the market up perfectly for 2020, because it would give that extra impetus to probably time the peak to coincide with October, November, as it did came in a little bit early in 2018, the peak of the market, or the economy rather, when we had that 4.2%, but and given that we started out with 3.2 this quarter, the odds are fairly high that we're going to be somewhere between 3 and 4% next quarter, possibly even 5 or 6% going into the end of the year. I wouldn't rule it out. So it definitely looks good. One of the things that's not so good is, which I made a point of mentioning yesterday, is that, as we've said on this show, and I said it myself, Google appeared to be heading for an all-time high, and the assumption was it was doing fantastic, because how can they do wrong, you know, in such a strong economy? Well, it appears they weren't quite doing as well as they thought. With
ad revenue is down today. Looks to be the worst day for Google since January of 2012.
Right, and so it's a huge deal, and it was a good short from our point of view yesterday, and even though we were a bit late to the game, but the point is, if Google can't perform well in this economy, you know, I hate to think where we're going to be if things get bad. So when you look at it from that standpoint, lowering rates isn't such a, you know, kind of a far-reaching idea, because it might extend the recovery by several years, in fact. And, you know, and I think that's, you know, look, nobody can say for sure. Just had a very engaging conversation with a guy out of Europe this morning who's very, very politically smart. And he's pretty resigned to the fact, and he's very highly connected with the political world in Europe. And he's resigned to the fact that, you know, the Brexit is virtually inevitable in the UK. And, you know, he sees this breakup of Europe coming that could be a big problem in the future. And to a certain extent, the fracturing that's going on in the US is also, you know, a problem, because we were also talking about gold, and as you know, it's just a while since I updated everybody on metals longer term outlook, not just the short term that's going on right now, but our whole reason for being in gold, and as heavily as we are, is because, look, most people don't understand that in the 1970s, you know, in the 1930s, the U.S. had a depression. The market lost 90% of its value, and we had 3 years of a negative economy, you know, a very seriously negative economy, and the consequences were brutal. They were terrible. But, you know, in the 1970s, remember, the U.S. market got cut in half. It fell from 1,000 to 500 in the mid-70s in 1974. And then the Fed stepped in and the market doubled, you know, it doubled from the lows of November 74 over the next year. I mean, it's very unusual, it's almost unheard of for the Dow to double in a year. Well, how did that happen? What happened? The Fed stepped in and basically saved the world, because at the time, Britain was going through a depression. They had a 3-day week. And imagine, you know, the whole country was only working 3 days a week. They turned the lights out every night because of the power, you know, the power crisis. 1973, actually, 1973, 74.
That's a part of history I wasn't familiar with.
Right. And so the Brits lost the market lost it went from 541.7, I think, down to 147, which is about a 90% drop. So Britain had its depression in the mid to early 70s. And then the greatest thing ever happened was the discovery of North Sea oil. And that solved the power crisis and the energy crisis. And ever since then, Britain's been on the mother of all worlds, you know, and it's gone from 547 to 7,000 in the market. It still underperformed the U.S., but it certainly had a very meteoric. I mean, it had a 10-fold rise off that 1974 bottom, you know, within the next 10, 20 years or so. So, and look, you know, I talked about Russia. I mean, Russia in 1998 was, you know, at death's door. And that was when you saw them banging on the banks, and there was almost a total meltdown. And the Russian economy, or the Russian market, went up 100-fold from that bottom. That's why there's so many billionaires in Russia. And same in Japan after World War II. You know, in the early 50s, I think my father told me the Nikkei was about 41 back in the early 50s, and it hit 39,000 by 1990. So I mean, imagine the rise, the meteoric rise from a 41 bottom in the market to 39,000. So, you know, we've been living in an incredible time of market gains. Now, the reason I'm talking about this is because what happened in the mid-70s when the Fed stepped in, and the Fed wasn't like today where everybody knew what the Fed was, and everything they do is kind of monitored and reported. Back in the 70s, it was really just the people on Wall Street, and not even the mainstream Wall Street people paid much attention to the Fed. So the Fed has had a couple of times in history where it's gone into bat in a big way and saved the world. Probably the first time was in 1922, around about the time when there was a crash. You know, we're tracing out a similar rebound from the 1907, what was the 1907 bottom back then, which is like the 2009 bottom of this era. And the market had a tremendous move up through the teens, and then World War I ended and the market went higher. And then in the early 20s, which I've been predicting for this era, you know, because there's two things that happen. If Trump doesn't get reelected, obviously Armageddon will be likely. And if he does get elected, probably have a couple of years of honeymoon, and then some sort of a disaster is going to be around the corner, and it could knock the Dow down to less than 10,000 again. It could take us down towards the 2009 bottom, much the same way as what happened in the early in the 20th century, in 1922. What happened was, it's like this last speed bottom that we've had the December route, where the market has just rebounded in, the mother of all beat bottoms. Same thing happened in 22. The Fed was only 10 years old, and they stepped in and got the economy back fired up. And guess what happened next? You had the Roaring 20s. I think the same thing is quite likely to happen in this era, and it's going to be an incredible time of enormous opportunity, because if you can see this coming, the money you can make both ways is going to be really something. So the outcome of that is sooner or later, just like the 1970s. What was the fallout from the Fed coming in and rescuing the market in the mid-70s? Gold went up eightfold from 1976 through 1980. This time the Fed has stepped in from 2009 to the power of 10. They probably have done 10 times more than they've done in the 1970s. So the fallout for gold could be 10 times upside from here, or certainly 8 times like before, which would take us back to about 750, something like that, or somewhere between 8 and 12,000. That sounds like a huge number today, but we were talking back to where gold bottomed at 104.6 in 19. Sorry, just a second. Just a second.
All right, guys, I just drew a trend line across the top of these candles here on the S&P. Now, this trend line and this trend line, that's that bigger picture, bugle, whatever you want to call it.
So the market bottom 104.6. Guess what it bottomed at in 2016? 1046, exactly 10 times higher. So what do we have? We have a whale of money, 20 to 30 trillion, pushing the economy high, in this tremendous momentum that we've got. But when some sort of an accident happens, and look, it could happen, really, we went from, I think it's a 7-year cycle that we're in right now. I may be wrong, it could happen sooner. But in 1976 through 80, it happened in 4 years. So guess what happened in 1979? Something similar to what's going on today, which is where the economy is starting to get traction, which blew everybody away. Nobody was looking for 3.2%. And when that happened in 1979, because remember, the Fed had done a lot of stimulus, and the NASDAQ, for those who are not educated, the NASDAQ went up 40% from late November of 78 through early 80, while gold went up eightfold. So don't say the market can't go up when gold goes up, because it can. It's done it before. and I fully expect it to happen again. And one of the reasons why it may happen is what happens if the dollar tanks later on this year. I mean, as a matter of fact, the dollar's down today. Why do you think it just sold off a while ago? Probably because of this $2 trillion stimulus that just got announced, you know, because that's who's going to end up paying for that. Probably the deficit, you know, it's going to be added to the deficit. So that's potentially very, very bullish for gold. So it does not happening yet, but if gold gets traction in the next few months, finds itself 1,1500 or so, I don't think it's going to stop going higher. And as a matter of fact, it could accelerate higher, possibly north of 2,000 before the end of this year, just as it did in 1979. Except in 1979, it went up fourfold in about 4 or 5 months. So, you know, there was a tremendous upside acceleration, not unlike Bitcoin, what happened to Bitcoin. So, I think it's baked in the cake. You know, it's either sooner or later. It's either going to happen in the 4th year of this rebound in gold, or the 7th year, which will take us to 22, 23. Maybe a double. We may get a rebound in this year and possibly rate hikes. You know, the Fed may lower rates first, or stick with stable rates, but they may be forced to raise rates later on if they get, you know, if the economy comes from behind and we suddenly start to see high inflation numbers. We're already seeing them, but the Fed is sweeping them under the rug right now so that nobody sees them. But the fact of the matter is the PPI is at 3%. It hasn't been at 3% since gold started rising at the end of the last decade. And we know where gold went from there. So
you saw the consumer confidence number, right?
What was that? What did that come out as, Dwayne?
Much better than expected.
In what way?
Well, here, hang on.
Oh, you mean consumer confidence?
Yeah, the economic report that came out today.
Yeah. No, that's an important thing, you know, and that's another reason why the market might be rallying too. So, but it's starting to get pretty exciting. So, if we do get an upside acceleration in the market going into the summer, that was obviously going to be great for everybody. But at some point in time, gold and the market get in sync, and you have gold going up as well as the market, kind of like what happened in 79, kind of like what happened in 2005 through 2007, and ultimately through 2011, when we went up, tenfold, literally, or not tenfold, but sevenfold from the 250 bottom of 2000 or 2001. So, and with this wall of money that's kind of, waiting to explode the system. I mean, eventually there's always a fallout from a financial boom, and that's probably what's going to power gold higher. So but at the end of the day, listen, gold went up eightfold in 1979. Was it the end of the world? No. Before it was over, before you knew it, it was over, and we had a 20-year boom, and it's quite likely.
Did you say?
Eightfold, yeah. From 1976 through 1980, went up eightfold, and silver went up tenfold. Silver was $5 in 1976, it went to 50. And what happened with gold is we had a double eightfold, we had a sevenfold rise from 35 to 200, then we had a 50% correction, and then we had an eightfold rise. This time is a little different. We had a sevenfold rise from 250 up to 1900, but we have had a 5-6-year correction, 5-year correction from 2011. So that leads me to believe that we're more than likely going to have a 7-year cycle in gold, which fits with the dollar. And if the dollar really starts tanking, it's going to be very good for gold. And sooner or later, the dollar's got to go down, because it can't stay strong forever. It's just the market doesn't work that way. There are these strong cycles, and we're in a stronger down cycle than is normally being the case with the dollar, because Trump's done such an incredible job with the economy. But in spite of all, the best thing that could ever happen to Trump, in my view today, is for the dollar to get weaker at this stage of the cycle, because that's going to help the market go higher. Why is a weaker dollar good for the market? And it's good for all asset prices, So real estate goes higher because real estate becomes a hedge against the weaker dollar. Stocks become more valuable because the dollar gets weaker. Exports, remember 2/3 of all the revenues in the Dow today come from overseas. So if the dollar goes down, the US becomes more competitive because its cost of production is less in global terms with a weaker dollar. And a weaker dollar, look, you got the Australian dollar an all-time record. Sorry, gold in Australian dollars is an all-time record high. And it's recently hit a high in 72 different currencies. That's kind of a harbinger of things to come. In other words, when the inflection takes place and the dollar does decide to get into a down cycle, which is highly likely from this point forward, remember it's a weaker dollar is actually going to probably guarantee even more a Trump win in 2020, because when you get a little bit of inflation coming into the economy, if we have 2.5% inflation, 3% inflation, kind of adds to GDP. So that'll give us a chance to get to 5% or even 6% GDP going into the 2020 with a decent amount of inflation. But at the end of the day, inflation, especially wage inflation, is good for the economy. It's good for everybody because everybody gets the feeling they're earning more money, and that's what we've been lacking for so long, because the disinflation has really hurt most of the the larger the middle class and the working class. But behind, how much could you buy a loaf of bread for in 2000 versus today? Or a tube of toothpaste, or the basics of life. And almost everything has gone up minimum 50% to 400%, in the last 20 years. So you've had this stealth inflation, which is making everybody poorer, and their wages have not kept up. They've actually gone down in real terms, which is really the biggest problem facing the country today, and is the reason why Trump was elected. Because there was too much of this inflation and disinflation. And the other thing is, when you've got all these immigrants coming in, and all, you've got Vietnam and North Korea and all these, and China, China initially, but China's pricing itself out of the market again, just like Japan. So these new countries like Malaysia and Vietnam are all disinflationary because they keep wages down on a global scale. That's what we're competing against. And when you're paying somebody $30, $40 an hour versus $3 or $4 an hour, or even a day, that's the reason why we lost 70,000 corporations.
But they're coming back.
Yeah, and as I've said before, unfortunately, we may get, the Fed may go into bat one last time. Everybody say they kick the can down the road, but one day the Fed's going to get in there, and they just won't be able to revive the economy, because it'll be a new kind of economy they've never dealt with before, something like called automation, among other things. But I think the automation fear, the smart money, people like Elon Musk are seeing the automation threat coming ahead of time, and they're sounding the alarm. But the reality is, a lot of the automation where there's going to be no truck drivers and taxi drivers and things like that, listen, we're probably quite a few years away from that being mainstream. And we might even be 10 years away, because I think that's going to be the cause of the next depression, which will probably come in the early 30s, just like it did 100 years ago. But in the meantime, if we do have a really bad crack at the beginning of the next decade, and the Dow did go down to 10,000, and the gold goes up and equals it, every so often, every 50 years or so, gold and the Dow meet price-wise, they equal the same price. Mm-hmm. So we get up to 8,750 and the Dow dips below 10 for a couple of days, then mission accomplished on that score. But the rebound, if the Fed step in and sort of recharge the markets one last time, we might just get a roaring 20s type run, just like a 100 years ago, a century ago. But instead of the car, there were 150 car companies at that time that fueled the boom, we might be looking at 150 flying car companies and all those sorts of things coming in this next era, and all kinds of things we can't even imagine just yet. So there's certainly enough innovation in terms of timing and everything else we've got the innovation, we've got the creativity, and we've got the mobility to create a decade of unprecedented wealth and almost delirious kind of utopia conditions that could come within the next 10 years. Are probably going to be a great time to be alive. But unfortunately, after that, we might run into a lot of problems if we're still around and we haven't, blown ourselves up or something. So that's the ultimate threat that we have to deal with. But
we talked at the top of the show there about Google and their earnings, and today being the worst day since 2012. And they are the mother of all search engines. That title was once held by Mama.com.
Yeah, I remember.
Yeah, if you don't remember Mama.com, think Mark Cuban and think $300,000 that disappeared from my personal Ameritrade account. But we won't go into that. We'll save that for another show. So, guess who the number 2 search engine is? Actually, some analysts say they're now the number 1 search engine. Do you know who it is? I mean, it's obvious. It's Amazon.
Bing or
No, Amazon.
Wow.
See, now that really took me by surprise, because I never go to Amazon to Google something. I mean, you have to think of
well, it's because
tissue that you blow your nose on over time became Kleenex, and searching on the internet over time became Googling for something, right? And there were more searches done last month, last week. I forget the statistic I read on Amazon than there was on Google. And now that's kind of sent shivers down Google's spine. It's reflected in the earnings. But again, I never go to Amazon.com to search for something. I don't think we'll ever Amazon.
Well, I think look, it's a more defined search because people are searching for products and that sort of thing. So it's an eye opener to think of how big that has become and how mainstream, because almost everybody today who's buying something is going to check the price on Amazon. They're going to check Amazon no matter what. So,
even if you don't buy it from Amazon, you're going to see what a fair price is.
Yeah.
And the amazing thing about Amazon is if you want to buy a widget, a specific widget with a specific serial number, that thing may be for sale on Amazon anywhere between $9, $19, $90. It just depends on who's selling it. A lot of people probably don't understand the Amazon ecosystem, and I don't claim to understand it all, but some things Amazon sells themselves. Other things are sold by third-party vendors. It's kind of a seamless place where you don't really notice the difference.
Well, there's a lot of people making a ton of money flipping stuff, They buy in bulk cheap and they sell it on Amazon at a premium or eBay, and there's a lot of people pay a premium for things they shouldn't do, maybe for convenience.
I understand how to get visibility on Google with Google AdWords and all of that. I think I placed my first Google AdWords for our wedding chapel back in 2003. So I'm familiar with AdWords. But if I had a product to sell, on Amazon, how do I get visibility for that product? Now, I know Amazon does have something similar to AdWords, and you can pay money for featured listings. But if you just opened a store on the Amazon ecosystem, and let's say you owned a domain called sometimesIwearafedora.com, and you sold fedoras, how do people find your fedoras on Amazon? That I haven't figured out yet. I got the domain, I got the fedoras, I just got to figure out the Amazon aspect. So, go ahead.
So it's going to be an interesting transition into May. I would say if we hold this rebound in the metals, like we can see on your chart right now, it looks like we're going to pull back a little bit. Yeah, we might pull back to that 29.35 again. And then if we start going up from there, I would think the odds of breaking out above 29.42 would increase, and possibly head higher tomorrow. But you don't know what they're going to say. Obviously, they're probably going to talk very positively, which would probably help the market. It may brush, if somebody else comes out with some good news in the next couple of days, it could negate the short-term negative effect of Google. It's just some sort of an anomaly, but it is a point. If we're sort of priced for perfection right now, given the 3.2% economy and the way, as I said, most companies are going to outperform, which has happened, except for this Google surprise. So, and that is a bit of a problem, in terms, because it tells you that if the economy did turn south, it probably hurt a lot of companies pretty hard. It would suck the energy out of the room pretty quickly.
I just don't think it's a change in the economy, it's a shift.
Yeah.
A shift from Google to some Amazon. So, we'll see how it pans out. Anything else you want to cover?
You know what? I think I'll probably wrap it up for the day. The thing that stuns me is, boy, these grains, man. They look like they had so much promise. I did tell people that if they were going to take that shot, to be short, don't risk more than a point or two. And if they went short, which is what we normally do when a situation reverses, you'd have made out like a bandit, because the grains have gone down a lot. The meal hasn't gone down too much, but the soybeans have gone down quite drastically. And so once again, we're probably getting to a level where you've got to be paying attention and start looking at getting back in for a possible upturn in the grains that could start in May. And also if the dollar, which is actually getting weaker, there was a big spike in the currencies this morning too. It would be a very good place for the dollar to actually start, reverse from here. And that may happen from what the Fed decides to do tomorrow. So let's see, I definitely think if we start breaking the 97 this time, if we went down below 96, that would be close to a terminal move for the dollar. So we'll see how it pans out here. But I think that looking at the dollar before the end of the day, sometimes you get a reversal on the last day of the month. And by the way, this is one of the weakest monthly closes we've had in some time as well, which may imply that there's a little bit more of a retest. It wouldn't hurt. As I've said, they were kind of overdue for a pullback, even though the market looks almost invincible even today still. But a pullback here in the first 2 weeks of May or so could be very positive, because that's kind of what happened in 1987, right before we went. The middle of May was the bottom, and it's actually when the dollar peaked. Dollar peaked right around the middle of May. Bond prices peaked, and the economy started getting stronger, and bond prices started plunging. So when you had the combination of a weaker dollar, rising interest rates, the market started getting confidence in what we've just been talking about, which is a strengthening economy, and it continued to strengthen into the summer, and that caused interest rates to soar, bond prices to plummet into a death spiral, and the death spiral is eventually what caused the 87 crash. Now that doesn't have to happen this year, although we could always get an 87 light or some sort of a crash in the third quarter perhaps, like often happens. But we certainly could get a big upsurge, because if we had a bit of a pullback here, it would create very good conditions for an upside breakout to new highs that could potentially carry us, to 3,300 on the S&P, and maybe up towards 30,000 on the Dow, something like that, maybe even 32,000, into a really ripper of a rally, and then the summer, maybe the mother of all summer rallies. So, and I think that's still on the cards, especially if the dollar gets weaker. If we sort of get the same conditions that produced the 87 rally, then you could definitely see the same thing happen this year. And it was 30% over 3 months. 30% rally in 3 months is basically what happened in 1987.
I mean, crude's up 40% this year.
Yeah.
That's a lot.
So, and that's a little bit bullish for gold too. And
Right.
if we get that inflation, assisted growth, revenue growth, GDP growth, and we have a kind of a surge into the summer, I mean, it would be really, really good. I think it would be very favorable and very positive. And even if we did get some sort of a pullback in the fall, I think we'd probably get, rebound going into the end of the year, and potentially set ourselves up for a pretty good 2020. And remember, we're kind of overdue for a decent third year of a presidential cycle. I mean, the last two have been bad, dead. No particular gain or loss. Was kind of a, we just got cheated out of 2 third-year markets, and very often a third-year market can be a 50 or 100% upside move. So, we definitely we're overdue for a really big third-year election cycle in these markets. So, on that note, we'll bid everybody a great afternoon, and look forward to seeing what the Fed have to say tomorrow.
Absolutely. We'll talk with you same time tomorrow.
Okay, much obliged. Thanks.
Thanks so much.
Bye.
Guys, that's going to do it for today. Got to jump. Thanks so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.